All right, let's take a quick look back at these markets. As we say, now we're hitting session lows. The Dow off 323 points at 23,635. The S&P and NASDAQ, by the way, on track now to have their worst week since January of 2016. The Dow also having its worst week since January of 2016. I hear from Charlie Brady, our senior editor. The Dow off more than 1,300 points this week. And also, well, we were off 720 yesterday, so we're down 1,040 points in just the last two sessions up to this point. So what's causing, well, again, this late afternoon sell-off? Let's bring in Bob Dole, Nuveen Asset Management Chief Equity Strategist and Senior Portfolio Manager. All right, Mr. Nuveen, what's going on? What's driving the markets? Is it one thing or is it a mix of things?
I think it's a mix of things. Obviously, the headlines today are all about trade, and I'll use the word uncertainty. Yeah, there have been tariffs proposed, but there's still to be worked out a lot of details. Will China and the U.S. come to the table and try to negotiate so these tariffs don't go into place? Markets hate uncertainty, and that's what we're facing. Earlier in the week, the continued revolving door at the Trump administration doesn't give the market a whole lot of confidence. The Fed meeting, it's clear interest rates are going higher. For years, the Fed was our best friend. They're slowly turning on us. Markets do best when interest rates are falling, not when they're rising. So you put all this together, and there are just a lot of headwinds out there. The good news is there's a big tailwind, and that is the earnings.
Right.
Economy's pretty good. Earnings are very good, and we're just focusing on the negatives appropriately because they've crept into the picture in the last couple of months.
But given how far we've come, I called you Bob Nuveen. It's Bob Dole with Nuveen Asset Management. I just mixed it up a bit. Sorry about that, Bob. Close enough on a Friday. Given how far we've come, Bob, is this somewhat of a healthiness to kind of, I said this yesterday, shake the tree, get some of the loose stuff out, build back up, but still on fundamentals?
Yeah, I think that's probably right. Look, we had that big correction that took the S&P down to 2532 at the low. We're still a few percentage points above that. This is a testing period. We may go back into that area. My view is we are in a broad trading range, and therefore, when we're toward the lower end, you do some nibbling on stocks, and conversely, when we get to the higher end, you got to let a little go because the environment is changing. The easy period of stocks go up because earnings are up and valuations are up, sadly, is history. Now we have earnings go up, but PEs are under some pressure, valuations. Yeah. And therefore some cross currents.
So I'm sure you're getting lots of calls from clients. What are you telling them? I'm hearing more and more that, you know, people are adding to their cash positions, not liking all of this volatility. What are you telling your clients?
Well, when you go down 1,000 points plus in a couple of days, somebody's doing some selling. You're absolutely right.
Yeah.
Our view is that having neutral positions makes sense. So if you're still way overweight stocks, pulling a little off the table is fine. But don't go too far because we're not in a recession. We're not in a bear market in our view. We're just in this period that gets a little harder and going to bounce around. We still think stocks will have an up year this year, but not 21% like last year.
Right. And also, Bob, you know, the FANG stocks, the big tech companies have led the way for quite some time. A lot of money going into those. As we see money coming out of those, we're not seeing it rotate into another sector per se. Will the big tech companies continue to be the leader, or should we look somewhere else?
I think those big tech companies probably not. Doesn't mean technology is finished because there's lots of other tech as well. As you know, energy's getting some money. The energy stocks have done better. Financials have taken it on the chin the last couple of days, but they have some good things going on. People are buying some consumer staple stocks to get a little more stability in the portfolio. So the rotation continues, and I think we're going to have a lot of vicious rotation, perhaps all year long.
Vicious rotation. It sounds painful almost. You know, Bob, we yes, have to talk about, we've been talking about higher inflation for a while. We've talked about, and you know, the higher interest rates coming. Does that happen sooner or later? Because to me, you know, the Fed seems a little bewildered on why inflation isn't higher, but ultimately it's going to come.
That's my view. And I'm not calling for high inflation or high interest rates, just higher than where we were. My line has been we're moving from very low interest rates and inflation to low interest rates and inflation. Low is higher than very low. It's not horrible, but it's not nearly perfect as we were last year.
But could you argue that the debate over tariffs, which we have seen have an impact on the markets, a concern of a trade war, is in a push and pull relationship with the tax reform and the benefits of that?
Yes. So let me put it in these terms. Out of the Trump administration, we've gotten a moratorium on new regulations and a big tax cut. Market positive. Of late, we've been talking about a tax. It's called a tariff. That's market negative, and that's why the market's having this this series of hiccups in the last bunch of days.
Do you like the financials, Bob? Because in a rising interest environment, that should be positive overall. I know it's going to be more expensive for everyone to borrow money, but they're going to get more money back in interest on their loans.
Yes, that along with a good economy and the low regulatory environment compared to past years means financials are probably a pretty good place to be. We've obviously seen some significant weakness in them this week. We would use that as a place to nibble. Don't be a hero, but averaging on in probably makes some sense. All
right. So once we get through this week, how you believe that this volatility, Bob, is going to stick around, probably get more of the same next week? Seems to me we're very much headline driven again, which will drive investors crazy. And probably the best advice is don't watch it minute to minute.
Bingo. I think we're going to have volatility in both directions, not just down. We're going to be into corporate first quarter earnings before long, and they're likely to be pretty good.